This is part 3 of Accounting and Business. In previous 2 videos, we have discussed in brief about accounting roles in business, type of business activities, and form of business entities. In this part 3, I will simply touch on a few things to complete the topic. That is, to discuss in brief about uses of accounting information, accounting professions, as well as ethics in accounting profession. Previously, I have introduced you to the 3 main reports of financial accounting that make up the financial statements. In these financial statements, I have highlighted the elements of each statement. In income statement, we have income and expenses that would result in either profit or loss for the financial year. In statement of changes in equity, it is all about equity. And in balance sheet or statement of financial position for corporation, we have assets, liabilities, and equity. Because we have different types of business activities, items in the financial statements will be a little bit different as well. For services, this will be the very basic. Here is the income statement. We have income and expenses and net income or net profit at the very bottom. For traders, we have additional costs. Under cost of goods sold, we have opening inventory plus purchase when we purchase new inventory and minus the remaining inventory at the end of the year. And in the balance sheet, we have additional item under current asset, which is inventory. For manufacturers, they also have cost of goods sold, but instead of purchasing new inventory, it manufactures its own goods. Therefore, instead of adding purchase, we have manufacturing costs instead. We also refer this item as cost of goods manufactured. In its balance sheet, we have to record the 3 types of inventories: the raw materials, works in process, and finished goods. Now let us move on to uses of the accounting information. Who wants to use the information and for what decision? The informations are prepared for 2 parties. We call them external parties, those outside a firm, and internal parties, which are those inside a firm. For external users, they are not directly involved in running the firm. For examples, we have lenders, shareholders or investors, governments, and external auditors. For example, lenders like banks, they need to decide should they or should they not lend money to this business, or if they already lent money, will they or will they not get their money back? Thus, in the future, should they or should they not lend the business more money? For government, they are more interested in tax. How much the business is making, thus how much that it can contribute in building the nation. For external users, they are those directly involved in managing and operating the firm. They use the information to help improve the efficiency and effectiveness of the firm. Example of internal users are managers, officers, internal auditors, budget officers, and controllers. Managers, for example, human resource manager, will need to decide, can we afford to employ more people as needed? Maybe as required by sales manager requesting more sales personnel, or by production manager who requires more people in the production line. Sales manager might need reports that show, have you reached the target sales for the year? If we have not, what should we do and what we can do? All with the help of the specific internal reports on sales. Now please note that the 3 reports that we look at just now, those reports are mainly for external users. For internal users, we have various other types of reports, which you will discover in your management accounting courses. From looking at the type of users, we can see that the type of reports are different for different users. Basically, those reports required by external users are the financial statements, and these reports are provided by financial accounting. As for reports required by internal users, those are the various other types of reports that are provided by managerial accounting or management accounting. Just a brief highlight on accounting profession. For accounting graduates, you may build a career in the track of private accounting or public accounting. Under private accounting career track, you will be employed by companies, governments, and not-for-profit entities. But if you choose to be in public accounting career track, you will be employed by accounting firms with accounting, tax, and audit services. Or you may opt to establish your own accounting or auditing firm. Depending on the level of education in accounting graduates may become a bookkeeper or a payroll clerk for a company. And since you will be learning about management accounting or cost accounting, which include budgeting for a company, you can be a budget analyst and cost accountant or management accountant. You can also be an auditor, those who check companies' financial statements and documentations for compliance with certain standards and rules. You can be an internal auditor, that means you check the compliance of the company that you work for, or you can be external auditor, where you check the compliance of your client's company. External auditor can also be advisor to the company. In an accounting program, you need to also study taxations and finance, and these open more doors. You can apply to be a tax officer or pursue to be a business analyst or financial analyst. So as you can see, there is no limit to what a person who studied accounting can be and use the knowledge that they earned. Coming back to accounting in business, as we can see earlier, the general objective of accounting is to provide relevant and timely information for user decision making. To ensure that the information provided can be used for decision making, a company must provide, in general, relevant, timely, and truthful information about its business, so that when making decisions, users can make an informed decision, meaning they can make decisions after taking into consideration all relevant and important information in relation to their decisions. Now, if the information provided by the company is irrelevant, untimely, and fake, meaning not actually representing what is going on in the business, users may end up making ill-informed decisions or less favorable decisions because they were misled by wrong information. And this boils down to ethics of the information provider, that is, the company that prepared the information. Ethics, in general, are moral principles that guide the conduct of a person. Having moral principles will result in ethical behaviors. As an accountant, you must practice your moral principles to identify ethical concerns in all decisions that you or your company wants to make, analyze the options that you or your company has by considering all consequences of the decision, and choose the best option that are available to you. You will learn in more details about ethics and governance in your business ethics and corporate governance course. Just to share with you a famous example of fraud, I bring you Enron Corporation. I like to use this example because not only that the company gone bankrupt, but it brought down with it one of the world famous and established accounting firm, Arthur Andersen. So Enron, just like any other corporation whose capital comes from the public, will provide reports that show their performance in terms of annual report, where financial statements are part of the report. However, instead of providing truthful information that represents what actually happened in the company, they distort the information. And this has resulted in users making ill-informed decisions. As a matter of fact, the chairman of the company, Kenneth Lay, actually encouraged Enron employees to buy Enron shares, saying that the prospect of the company is looking great, while knowing for a fact that the company is going down at that particular point in time. And at the same time, he himself sold his portions of Enron shares, taking advantage of the demand for the shares that he himself created among Enron employees. Ironically, Arthur Andersen, the external auditor of the company, also acts as consultant to the company. In other words, they advise the preparations of the company's financial statements, and at the same time will also be auditing or checking the financial statements to see if they are prepared according to the law and standard. That is a very red flag. It is definitely a conflict of interest. So they need to be responsible for the distortions of the information provided in the annual reports because they are the ones who endorsed it. At the end, to cut the story short, Enron filed for bankruptcy. Those who invest in the company lost their money invested, and Arthur Andersen forced to be dissolved for its unethical role in the whole scandal. We can say that Arthur Andersen actually became part of the enabler of the scandal. Now, I believe there are thousands of people who work in Enron and Arthur Andersen who were ethical, but unfortunately they had to bear the consequences of those in high positions that made unethical decisions. You can read more about this yourself, but you might discuss this in your audit course since this case has become a classic case of ethics and fraud. That is the end of this topic. In our next session, we will discuss conceptual framework of MESB, Omniscient Accounting Standard Board, where, among other things, we will be touching on the objective of financial statements as well as their elements.